these out. Hey, lucky boy. Such a good guy. 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 Oh, boy. Lucky boy. But I don't need this anymore. All right, should be live. The one. Hello. And CJ Yukon, Narad, Tim, John, Platinum. Oh, I had an article on Platinum. I'll see if I can find it. Let me write it down. I don't have it right now, but I had one. So let me see if I can find it. Platinum. Platinum. Hey, pilot. Well, David, when I say that I think the market's going to do, a massive run to big numbers up, it's not because the economy is good. I'm not saying that. In fact, I think and this is what's so scary for me, and I think it shows up in tension or impatience, maybe is a better word that I have. Nobody understands, because we're human beings. We look forward through our rear view mirror. So we judge how tomorrow's going to be with how last year was, or 2 years. That's the most our brains go back. But I really think it's a lot of things. It's the baby boom generation having expanded, the economy is now going into a period where their demands are going to be on the healthcare system, retirement. Not really buying a whole heck of a lot. This just-in-time worldwide system of delivery of goods and services, I think, is going to fall apart. Mainly because the United States has squandered her role as a trusted agent, and it looks like we're going to war. So the supply, the sea lanes, for example, the Persian Gulf and the Suez Canal and the Straits of that's the Straits of Hormuz, but the straits down near Malaya, where oil goes through to Japan, all pretty much free of interception. That's the United States Navy for all these years. That's falling apart. So then there's going to be a period of adjustment. I think what it means for us, David, probably at some point, is that we're going to have no choice but to rebuild our own capacity. We've given it all to China and Malaysia and Mexico, all because our world is run by banks and private equity. But I think one of the, and I got to read more about it, but one of the mistakes private equity makes is they get into a lot of illiquid assets, and they make all these assumptions. These are just idiots out of Harvard Business School. They're not any smarter than you are. They just are good at passing an exam and doing some sort of thought process. So they all do the same thing. And then, I mean, as an example, real estate, they're buying up real estate all across the country, trying to buy it all up to get returns. Well, is that the right thing to do? Maybe. But I'll tell you what, once you're in it, you're not getting out. And, or you're not getting out easily. And I just think private equity, if I had to guess, it's a nice ride on the way up, but the way down is on the way down. It's going to be really unpleasant. Um, so anyway, I think trucking will come back, but it'll be after we have a real dislocation. And if I were you, David, I'd think about buying a depot near trains or near a port if you can afford it, and you'll be a superstar after the crash. One way to do it, I'll just use you as an example. If you could buy, I don't know, 1,000 ounces of silver over the next few months, it is entirely possible that in a panic and in a dislocation, that 500 ounces of silver could buy an entire trucking facility with loading and what do you call those when you back up and the door opens and they slide the stuff in? Loading docks with, with 200 docks, 1,000 docks right next to an airport, or better yet, next to the Mississippi River, or trains, just something like that. Because I think in the future, trucking is going to be a very local experience rather than a cross country, just because I don't think it's going to be affordable. But I don't know. That's just an idea. But silver, for everyone listening, gold, platinum, can be something you could, I bet. What kind of time frame? I mean, it could be next year. I hope not. I hope we have time. But let's just say within the next, by the end of the decade. Let's say on the anniversary of the Depression. Let's say everything happens 100 years later. So sort of in the 2029 to 2035 range. Maybe, maybe 100 ounces of silver buys a house. Maybe 1 ounce of silver buys a house. You never know. Things can get really out of whack. Really out of whack. Or you can buy a multi-unit building near a college or a university that has rental income, but in the near term, there's panic, there's blood on the streets. You might be able to buy an oil company. You might be able to buy a farm. You might be able to buy an apple orchard. Why can't I say that word? An apple tree farm, coffee farm. Who knows? Who knows? Let me see what call Ham. He thinks you're not. Thanks. I'm gonna hold off. Ham did a call already, so his energy level is spent. I'll call Ham in a minute. If you need to hear, I'm sure you were on Ham's call. If you need to hear from him again, tune in in about half an hour, and I'll try to get him on. And in the meantime, you don't have to listen to what I'm saying. But I'll try to find this article on platinum. I do want to tell people, those of you who did invest and those who expressed interest, the little, it's not so little. I mean, it's little right now, but I think in a year it could be massive. The little gold company that I told everyone about. Um, I've been told they're going to close this offering on August 15th. That's Thursday. So I pretty much have gotten back to everybody who expressed interest, and I've let them know. But I think you could still let me know if you do have interest. There's still 2 or 3 days you could get in on it. Basically, this is a company which was public. It's now, for all intents and purposes, a private company, although it still has maintained its ability to be public. I personally don't think the shares will ever trade again as this company, because after this pilot plant, I think the company will either be sold or joint ventured, and our shares will be exchanged for a bigger company. For example, this is a Nevada-based gold company. It's never produced any gold, but it has proven, and I put that in brackets because this was about 15 years ago, a little less than 14 years ago, with third-party verification. They proved up their resources. These are sands, and they proved up their resources using caustic fusion assay, which is a typical assay method. They proved up almost 7 million ounces of gold at a recovery rate of 0.038. That's very low, 0.038 ounces of gold per ton of sand. The testing that's been done since, and repeatedly and in large number of tests, now gets 0.20. So instead of 0.038, they get 0.20 ounces of gold per ton. And that would be equivalent, if they can prove this up in the pilot plant. Right now, they've proven it to their satisfaction in the laboratory. But they really, to get a company to come in and buy them or to joint venture with them, the best thing to do is, they already have a pilot plant, but an earthquake essentially destroyed it. So they have to refurbish that and then bring in equipment for a commercial process. And that, if they're able to prove this, which I think is highly likely, it's not no risk. Otherwise, the deal would be priced at, $1,000 a share. But I'm making that number up for drama. But I expect that they will prove this out by the end of the year, the end of the first quarter. Let's call it the end of the first quarter next year. All of a sudden, you have 35 million ounces of gold, and that's without any further drilling. And this project, there's a north zone and a south zone. In between, there's no reason to believe. I mean, there's no reason. It should be the same resource should be in between. It's all sand. It's all been deposited over millions of years. So they're going to use this to drill double the depth and drill in between and outward. And that 35 million ounces of gold could go up, I mean, by multiples. It could go up 2 times, 3 times, 4 times. So this could be a huge discovery of gold in Nevada. And I think it's a 9-month time frame. They have nothing else to do. All they have left to do is to produce it in the pilot plant. So the money they raise is for overhead, claim, to keep the claims current, taxes and the rest, but also to um, uh, refurbish, equip the pilot plant, and produce gold for 2, 3, 4 months. What it means when you're doing it in a pilot plant is you're doing it at a much smaller level. So they're raising about $5 million. They don't need all of the five. They could probably just do four, but they're raising $5 million total um, to build out this plant. If you were to build out a plant to just produce it yourself, you're probably spending, I don't know, on the cheap end, 20 million, but I could see, depending on the volumes you want to produce, you could spend 30, 40, $50 million building out a production plant. So the purpose of a pilot plant is to do it without diluting shareholders any more than necessary in terms of numbers of shares, and then proving the process works. And then you go to a Barrick Gold, Newmont Mining, and they come in and they build that bigger plant. I also think one alternative this company could have is just produce it on their own. And I can go to Sprott Asset Management because of introductions made to me, or to Rick Rule's firm, and I think I could source that financing. But I don't think it's going to be a problem. Once this starts producing gold, the phone will be ringing off the hook because this project is, I don't know, an hour away by car, maybe 2 hours away, 3 hours away from the Gold Strike processing plant for the Carlin Trend. The Carlin Trend has made Nevada the country's largest gold producer, and the Carlin Trend is sand. It's sand. They produce gold that's 0.03, 0.03. They produce it in giant autoclaves, basically heat, pressure cookers. And that's a joint operation of Barrick Gold and Newmont Mining. I think the fallback is just, with gold prices where they are now, just sell this without proving anything up to Barrick and Newmont. Just sell the sand. They've already gotten a bid that was worth, if everything worked out as it went, worth about 20 cents a share. They turned that down because it was capped. That was the cap. But that guy would probably come back at 40 cents. I think if the company were just sold as is, with higher prices like gold is currently receiving, I think they could sell at 8 cents a share. But that's all speculation. So I think the downside in this little opportunity is not zero, although you have to accept that it's highly speculative and it could go to zero. I think the downside is just selling the sand to Newmont so they can run it, and Barrick so they can run it through their autoclaves. I think that's worth, I don't know, 40 cents a share. The cost of this is 4 cents a share, this offering. So I think the downside, and it's speculation on my part. It's a projection, not a promise. I think the downside is probably 40 cents a share, but it could go to zero. I guess it could go to zero. I don't think it will. But the upside is just enormous. I would say if they sold in, let's say, the first quarter, everything goes well, and they sell the company outright, just a conservative number there, I'd say $4 a share. If they joint ventured or just built it out themselves, again, conservatively, I think it'd be $40 a share. The offering is 4 cents. The risk I see is, what about the bigger financing? Because we're we're but a small part of that. Well, from what I understand, the company has raised the has gotten a commitment. Not the money's not in, but they've gotten the entire commitment for the larger part to build out the plant, spoken for. So I think it's really exciting. But it's going to be gone on Thursday. If you are interested, and I'm not giving anybody any pressure, I have to give your information to the company. They'll send you the documents, and they have a company presentation, which they can send you or I can send you. But you'll be buying it. You'll be interacting directly with the company, not through me. But anyway, I'll put up my email here. And if you want that, if you want information, um, give me your name, phone number, address, and how much you would consider investing. I'll have the company send you the documents. If you want to do it, do it. If not, don't. The minimum is $5,000. There's some people that wanted to put in less than that. I was unsuccessful at getting the company to allow less than 5,000 as an investment. I looked into setting up an LLC to help people that wanted to do less, but I was advised by my attorney that it was a path that opened up too much legal liability in terms of reporting and other SEC rules. So I'm not going to do that. He said don't do it, so I'm not going to. So the minimum is 5,000. It closes on Thursday. I'm not trying to pressure anybody. I don't think you'd ever see this kind of offering ever. The reason it's there is the guy who's kind of the spearhead of it, and it's his group of investors who have financed it. He's still great. He's still very smart and active, but he's gotten old, and his ability to write a check has been taken away from him. So we're able to do a little bit of this tiny bridge financing at just a attractive as all heck price, and the number is 4 cents a share. I think if they just sell the company without building the plant, I mean, they might get 40 cents a share. If they sell after the plant produces, but they don't demand a high number, I think the sale price could be around $4 a share. If they produce it or joint venture it, and maybe the stock starts trading, or we get stock in Barrick Gold and Newmont Gold or something, I think the equivalent price per share could be $40 a share. That would take a little longer. That would take, maybe. Remember, I'm doing two things. On the one side, I'm talking the positives. On the other, on the negatives, it's a speculative investment. It could take more time than I'm saying. It could go to zero, as all investments can. But I think it has the short squeeze type potential without the shorts. And I think in 3 years, if everything went swimmingly, it could be $40 or more. So it's a nice little thing. But the minimum The minimum is 5,000. So that's a significant commitment for most of us. All right, done with that. Can't find my glasses. Here's a pair of glasses. I do want to read from this gold book, but there's two other concepts I want to get out to you. And then I will try to get Ham on. One is on FNGR. FNGR did an offering, which I didn't expect them to do, but it's the good side of it, it's with current investors. It's not a toxic deal, so it's not setting up more and more destruction. Once they absorb it, it's over with. But like ever, the insiders, they started putting money in at $2.50. The criminals just manipulate the stock price down. It's all manipulation. There are buyers in there, but they just walk it down, walk it down. Ann Wagner couldn't give a tinker's cuss. Adina Friedman smiles. Tee. And Robert Cook sits on his rather wide haunches, and they do nothing. Nothing. So the fraud gets the price down. So what do the human beings say? Well, we already own so much of FNGR, but we don't want to put money in at 250 because the price is going down. So we're gonna ask that it be priced at $1.50. And they figure, hey, we're getting a deal. We're putting up the money. Look, we negotiate a good deal. What they forget is it's all self-fulfilling. Now it's easy to tell you this, but I think FNGR will go to $1.50. It'll go to the price of the offering. It might go below it. It won't stay down there very long. It'll be an opportunity to buy it. But that's just what the market does. They don't leave. The market never leaves an arbitration, ever, ever. And the big wealthy guys think, I'm getting a deal, yay. Well, they paid for the deal because they're only putting up a few tens of thousands here. They've already invested so much in the past. So they have one guy there has 11% of the company. So maybe he's putting a little bit more in at $1.50. Wow, I got a great deal. But then his entire 11% comes down to reflect it. It's disappointing. But I think you, everybody, me, every day you got to watch it. We're going to worry it. Oh, I got to watch it. Oh my God, it's going down. Oh my, is there news? What did they do? The CEO needs to say something. Oh my gosh. That's not how to do it. The way to do it is study the fundamentals, believe in it for 6 months. Give yourself a time frame, 90 days, 6 months, 9 months, a year, and buy it. And just assume the market's going to go against you after you buy it. Just assume that. It always does, until it doesn't. But I think mostly with FNGR and everything you're looking at, we're in the middle of August. The bankers are at the beach. Brokers are at the beach. Big investors are at the beach. Journalists are at the beach. Everybody's at the beach. So I would just plan on good things happening in September, not August. If you wanted to buy FNGR, I'll look at a chart at some point while we're on. But I would guess you could put orders to buy at $1.50, $1.45, $1.55, and then they'll go off. The stock now is 166. So those clever gentlemen who, to their credit, are putting up money when the company needs it, they say, well, I don't want to do it at 250, which was the market price when they wired the money. They all agree to do it at 150. Well, they outsmart themselves. The stock will go to 150. That's a guarantee for at least a day. It won't stay there. But you're all going to say, oh my gosh, is something wrong. I mean, if you don't understand by now what the criminals do, they sell stock without borrowing it, without locating it, in the hurry. They do it rapid fire because they don't have time to locate the stock. They don't have time to borrow it. They don't have time to deliver it. It's so important to get it all done. We live in a hurry-turvy world, and we got to get things done, 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 done. Well, they do that. It becomes self-fulfilling. CEO has to raise money. Here, at least, he's not signing a deal with the thieves and the dishonest man who is Jeff Easton, completely crooked firm, the Lynn Partners of New York City. Completely crooked. Any CEO that does business with Jeff Easton and Philip Valier deserves what they get, and you can listen to me. You smarter than every other CEO, smarter than the rest of us, Jeremy Frommer. You didn't want to listen? Look at your stock. Oh, we can't find any evidence, and it's just the computers, and it's the systems, and the markets are broken. And I'll set up CEO block, and the ability of small caps to raise market capital in the market is just going to cease to exist. But me, as a CEO who is charged with looking out for shareholder interests, I'm going to go ahead and do a deal with Jeff Easton. You know what smart is smart does. Jeremy Frommer. I like Jeremy, but what a dolt. The good thing is Finger is not doing business with Jeff Easton. This is a good time for me to tell you, remind you, all of my videos are editorial. They're in my judgment and they're in my opinion. I think that Jeff Easton is a thief. He has no talent. And if you're a CEO signing an agreement with him, you'll be CEO in name only. All you're going to become is a hamster running on a hamster wheel for the rest of your career. While he gets kickbacks from his clients. His clients will strip all the juice out of the lemon right up front for themselves. And then they buy Ann Wagner, they buy Gary Gensler, and then the press says, well, you shouldn't have invested in over the counter anyway. And you'll go, oh, I was stupid. I shouldn't have done it. And look at the market cap and the company. Yeah, I guess they were right. It's just a pattern. And it's unfair. It's all unfair. But CEOs have to understand what they're doing. I think sometimes they do. I think sometimes they know exactly what they're doing. And a guy like Jeremy Frommer, who in his own way likes to come across that he's open and honest, he's telling you, and he's smart, and he knows the systems, which I agree with. I can agree with every one of those points of view about him. I've met him. At the core, why do you do the deal with Jeff Easton? Smart is as smart does. Every single company Jeff Easton funds goes to zero or close enough that the difference doesn't matter. Every CEO that does business with Jeff Easton, Philip Valier, the Lynn Partners, New York City, wipes out his or her shareholders. Well, can you prove that? Life is a box of chocolates. If you get one with a cherry pit in it, that's what happens. All right, it's 2 o'clock. So I'm disappointed with that offering. I had something to do this morning, so I couldn't get on and tell you, but I spoke with some of you individually on Sunday, and I predicted Finger would go to $1.50. It's not much of a prediction now, is it? I think I said it when we went live on Saturday too. And I think I've indicated that you could put orders in under the market. I think I've said that for a few days, but that's the problem. Let's see how low Finger went today. $1.63. On GTII, I wouldn't trade it, but I guess it's all with the court right now. Maybe they'll come back with something. Nothing on my screen is particularly green today. So I'm going to suggest to you that these are the dog days of August, and it's a good time to accumulate if you want to. It's a good time to buy calls on things if you want to when they don't have a premium. And it's a good time just to do nothing. Just go to the beach, have fun, don't worry. Nothing's really big going to happen in the markets, unless we go to war or unless an asteroid hits. You got to wait till everybody comes back to school, and it's going to be September. All right, so I talked about that. One other thing I was thinking about over the weekend for everybody. I'm warning you, and I'm trying to get these thoughts across to you, that the things that you have valued for the last 40 years, 45 years, the dollar, the stock, the overall, the index, the big stocks in your account, the idea of a 401k, U.S. power in the world, the ability to import wine from France for $3 a bottle, being able to import ham from Spain and import oil from the Middle East for next to nothing. All this life of plenty, even though you have stresses, even though life is hard, this life of plenty is going to change, and doesn't mean that life won't be good, but it's going to be different, and it's going to be different for decades. I would guess at least 2 decades, and it may be that the modern experience of abundance, which in essence allows each of us to live better than Cleopatra. We have air conditioning, we have indoor plumbing. Now, she probably had all that with the fans waving and with people in there to wash her private parts while she bathed luxuriously, possibly. But we have just-in-time delivery of music. Do you think she ever went to a rock concert? Was she ever able to put Barry Manilow on her hi-fi and turn up the volume? Could she take her Jaguar out on the highway at 100 miles per hour? Could she go from uh, Alexandria to Rome in 45 minutes by air? No. We live a life better than Cleopatra's. All of us. That could very well change. Um, should we all live that well of a life? I don't know, but that could really change, or it could be challenged. It's a good thing to think about how you're going to prepare for it. But the plentitude of these long supply chains and working with China, India, Vietnam, Croatia, Africa, Russia, even it's at risk right now. Anyway, the thing I was thinking, and this is one thing each of you can do. Some are busy and they can't, but all the crap in your house that you don't really need that has value, new. You might have new things in your house that you don't use anymore. Furniture, the extra bedrooms, air conditioners, extra televisions, old collections of CD. I don't know. Anything you have that you're thinking, I don't really need anymore, why not sell it now while other people have money? Sell it now while everyone is feeling good with money. I don't think any of that crap you have that you don't really want, if we go into a depression, it's not going to have any value. Why not sell it now and turn it into gold? Turn it into shares of a mining company. Turn it into paying off your credit card debt. So one of the things that I'd like to suggest to you is you sell all your crap while people want to buy it. All right, Ham just wrapped up his space call. Oh, that's good. Um, speak freely. Don't wait for him. Don't wait for him. He's just done a call, a space call. You missed it. You can go. I'm sure it's recorded. It's probably with busy. You can go listen to it. You can go listen to him. I guess I can skip those pages. But thanks, Speak Freely, for stopping by. You know what? I'm not going to call him just because of your comment. I'm not going to ask him. So Ham is not coming on. If you're here to listen to him, he's not coming on. I'm not going to ask him to come on. So Speak Freely. See you later. Ham just wrapped up his call. So you can go listen to it. You can go listen to it on the recording. For me, I'm going to read chapter 6, and those of you who are on your lunch and want to hear Ham, just drop off, go to Spaces, and listen to Ham's call. I'm sure it's recorded. Okay. This is a short chapter. Thank God it's a short chapter. It's only about 5 pages long. It starts out, it's chapter 6, booms and crashes. Men, it has been well said, think in herds. It will be seen that they go mad in herds, while they only recover their senses slowly and one by one. That's Charles Mackay from Extraordinary Popular Delusions. And the masses, God, my eyesight. The Madness of Crowds, 1841. Okay, so this is chapter 6 in Michael Maloney's book, Gold and Silver. The stock market crash of 1987 is known as Black Monday, but I call it Mysterious Monday because no one seems to know exactly why it happened. One thing is for certain, the crash of 1987 was the largest one-day crash in history. The most popular explanation was computer selling. Remember, that's 87. By program traders. Others say it was a correction due to overvaluation, or others blame it on lack of liquidity. One of the better explanations I've heard is that the preceding run-up was similar to the run-up before the crash of 1929. Rumors spread and the dynamics of herding and mass psychology take over. The real cause of the crash of 1987 probably goes back to the late 1970s and early 1980s. Paul Volcker took over as chairman of the Fed in August of 1979, a Jimmy Carter appointment. Jimmy Carter was president until 1980. Paul Volcker, and he appointed Paul Volcker. Paul Volcker took over as chairman of the Fed in August of 1979. Jimmy Carter appointed him, not Ronald Reagan, and realized the need to raise real rates. Interest rates minus inflation, that's real rates, interest rates minus inflation, into positive territory to get runaway inflation and the price of gold under control. The higher rates only served to make a really bad recession worse. And by the time Ronald Reagan took over the White House in 1981, the economy was in bad shape. So in March of 1983, the Fed goosed the economy by eliminating the reserve requirement on time deposits of 30 months or more. And in September, they changed it to only 18 months. In the 2-year period from January of 1983 to January of 1985, the currency supply increased by a whopping 21%. On top of this vastly increased currency supply, the Fed reduced rates from over 11% in 1984 to about 6.25% by 1986. They took it from 11% to 6.25%. All that currency had to go somewhere. The economy took off like a rocket, and the S&P more than tripled, going from 100 points all the way up to 338. In a short period of time, the index went from extremely undervalued to extremely overvalued in terms of earnings. The investing public was caught up in a contagious euphoria similar to that of any other bubble and market crash in history. This euphoria made people believe once again that the market would always go up. However, due to extremely strong economic growth, inflation was becoming a concern. The Fed raised short-term interest rates to temper inflation. This had a negative effect on the markets. On Wednesday, October 14th, 1987, a sell-off began. By Friday, the Dow had plunged more than 10%. Then on Monday, October 19th, 1987, the majority of U.S. stockholders attempted to sell all at the same time. The market couldn't handle so many sell orders all at once, and most people couldn't sell because there were not any buyers. The Dow lost 22.6%, and more than 500 billion of wealth was transferred in one day. So the Dow went down 10% on Friday and then was down 22%. So you can see the recent collapse doesn't touch this as in magnitude, at least not yet. The crisis wasn't just confined to the United States. Markets in Australia, Canada, Hong Kong, and the United Kingdom fell more than 41.8%. That was Australia. Canada 22.5%, Hong Kong 45.8%, and the UK 26.4%. Fearing the crash might cause a worldwide depression, banking crisis, or both, the Fed intervened by increasing the currency supply, which had the side effect of taking the real estate booms, which were happening in different pockets of the country, and turning those booms into bubbles, mini bubbles. During this time, home values skyrocketed. A friend of mine owned a house in Las Vegas she bought in 1970 for 64 grand. In January of 86, it was worth 425,000. By 1988, by the end of 1989, her house was appraised. It was 1.3 million, a whopping 200% increase in just 4 years. People in her area were trading homes like crazy. For sale signs lined every block, and it seemed like everyone was talking about real estate, buying real estate, or becoming a real estate broker. Sounds like recent times for us too. All through 1988 and the first quarter of 1989, the Fed raised interest rates from 6.5% to almost 10% to try to stop the speculation. The Fed accomplished this objective. The property boom went bust, and recession started on the East Coast and swept across the country. Then on August 2nd, 1990, Iraq invaded Kuwait, and on January 17th, 1991, the United States commenced Operation Desert Storm. Once again, we were at war, a war we could not afford, and we funded the war by deficit spending. Home prices slid further, and the country fell into recession. In response, the Fed cut the reserve requirement on time deposits from 3 to 2%, and in 1992, it cut the reserve requirement on transaction deposits from 12% to 10%. Over the same period, interest rates were slashed from 8% to 3%. By this time, these measures had little immediate effect, and the economy continued to drag. Ironically, at the time of this writing of this book, which is 20 years later, we again have a Bush as president. We are again at war in the Middle East. Housing prices are dropping dramatically. This was in the 2008 period of our economy when this book came out. There is talk of interest rates being slashed to 2%, and the economy is lagging. Okay, I'm going to skip several pages while he talks, paragraphs while he talks about his friend's real estate house. So anyway, he says that property values went down, but anyone who bought income properties in the early 1990s could easily get property which cash flowed well. And soon after, real estate values started appreciating. Um, all the fiddling the Fed did with reserve requirements and interest rates back in 1991 and 1992 finally kicked in with a vengeance in 1995. In 1995, the currency supply exploded and never looked back. In the decade from 1995 to 2005, the currency supply increased 120%. That means that in those 10 short years, more currency was created than in all the preceding 83 years. In 10 years, more currency was created than in the preceding 83 years. In fact, more currency was created than the entire previous history of the United States. And it resulted in the biggest real estate boom in history, as well as a whole bunch of bubbles in bonds, derivatives, consumption, debt, and stocks. This book, let me tell you when it was. It was copyrighted in 2008, and the first edition was printed in August of 2008. But the bubble of all bubbles, until now anyway, was the tech bubble of the late 1990s. I'm sure you remember the story. The story started with honest companies which came out with good products at the right time. Their quick rise and huge profits attracted other companies to jump on board the tech train. As the train accelerated, the masses lost their collective minds and they threw money at companies of no substance. Basically, anyone with an idea could get together, incorporate, go public, buy Ferraris, install a golf course in their backyard with the proceeds, and issue stock like toilet paper. Finally, in order to prevent a market meltdown, the Fed, with Alan Greenspan at the helm, pumped so much liquidity that the market started to rise at an amazing pace. The frenzied speculation sucked in so much capital that it eventually became a pyramid scheme, required ever increasing mountains of currency to maintain its upward trajectory. Essentially, the dot-coms turned into dot bombs. The financial fallout included the popping of the dot-bomb bubble, the collapse of companies such as Enron, WorldCom, and Global Crossing. Many investors lost their retirement funds, houses, and savings. So, as you might have guessed by now, the lesson is if you jump into a market when everyone else is doing the same thing, you're probably too late. On the other hand, if you get into a market early when it's fundamentally undervalued, then wait for it to become extremely overvalued and sell once a true top has been established, you should do very well. In the case of the NASDAQ, there were 14 years where you could have bought your 10 tech stocks while the index was under 1,000. And you had about a year to sell your stocks over 3,500. If you timed it really well, you were able to sell your tech stocks at 4,000 or 4,500. Good for you. Unfortunately, that's when most people began buying, not selling. In the end, the bubble burst and lives were ruined. It requires a lot of education an investigation to find an undervalued asset class at the beginning of a new bull market. Those opportunities only go to the very few who do the work required and those that are able to think for themselves. Most investors get their advice from the same place as everyone else. They do things they wait for advice to come to them from the TV, the big investment firms, from their friends and neighbors who are already getting rich, at least they are on paper. During the dot-com rush, most investors who bought into the mass merchandise advice also bought into the pitch. They believed that in the new paradigm and the sentiment that tech will go up forever. They also bought their tech stocks after the NASDAQ index had passed 3,000 and held on, hoping for a turnaround as the index sank all the way down to past 2,000. But remember, in times of financial upheaval, wealth is not destroyed. Wealth is not destroyed. It is merely transferred. You got to define wealth properly, of course. The opportunities this creates for the educated investor are enormous. The pain and suffering that was the popping of the NASDAQ bubble could not only have been avoided, but also capitalized on by investors with the guts to change course when things didn't seem quite right. Like when the NASDAQ went vertical in late 1999. I'm talking about investors who are educated enough to discern the difference between price and value. The price means nothing. Value is everything. All right, I'll stop reading for today and I'll answer. All right, Steve. All right, Steve is tired and he's falling asleep. So I'm going to thank everyone for tuning in. And Ham's calls on X. I'll let Steve get back to work. And I'm sorry, Steve, that I wasted your time.